Hello, everyone. In Chapter 2, we are going to be accounting for business transactions. In Chapter 1, we entered transactions into our accounting equation. However, that's really theoretical. We really don't do it that way. Instead, I offer you this process, which is more what we do in real life. We analyze the transaction, we journalize the transaction, we then post the transaction to the ledger, and at the end, we'll prepare a trial balance. And of course, that trial balance will be used to prepare our financial statements. Let's talk about analyzing transactions. You know, in real life, you're not going to get a sentence saying bought office supplies on account. In real life, they're going to plop a source document into your inbox. For instance, you might get a bill from PG&E. Well, that bill is a source document that triggers a transaction, and it provides objective evidence that transaction happened. So what do you think a bill from PG&E is? What does it trigger? Well, it triggers the fact that you're probably going to have some utilities expense and that you owe money, right? So it's going to increase your liability. Once we have that source document and we analyze it, we then enter the transaction in a journal. And a journal is a day-by-day listing of transactions of a business. It's like a diary. When I was in high school, my sister was in middle school, and I remember going past her bedroom and I saw that she had her diary open, and it was usually locked. I know I should have done this, but I went in there and I took a look at her diary, and it says something like this: on January 1, I'm going steady with Johnny. I love him. On January 5th, I hate Johnny. He's a jerk and I never want to see him again. On January 12th, Johnny brought me flowers and he said he was so wrong, and I'm going to forgive him. I'm going to love him forever. Okay. Well, our journal in accounting is not that juicy. For instance, ours would say on January 1, bought office supplies on account. It doesn't work, does it? Quite as much as my sister's diary. But that's what it is. It's just a day-by-day listing of those transactions. Now, those transactions can be from, incurring expense to paying cash to receiving cash. But what we need to do is post those transactions to a ledger. And what is a ledger? It's a collection of all accounts and their balances. And it's like a glorified set of T accounts. Now, you don't even know what that is yet, but you will later in another video. But think about what a ledger contains. Think of it as there's a drawer and of a file in a file cabinet, and there are cards for each account, like cash, another card for accounts receivable. Well, if you pull that cash card, you can see from the transactions that were posted to the cash account that you received this much money on February 1. You paid this much money on February 2. And here's your balance in your cash account. Okay. And I'm going to explain this. This is just an overall video. So just try to see the process, and we'll discuss all of these in more detail later. And then, of course, at the end of the period, we're going to prepare a trial balance. And that's just a listing of all of the accounts that are in the ledger and their balances. Now, I say that trial balance proves debits equal credits. Well, you don't know what that means yet, but you will. Okay. And I just will say that the trial balance is not a financial statement. It's something that we use internally for accountants. Okay. So anyway, that's pretty much it. We will see you in the next video.